Hello everyone. Every year several clients walk through my doors and are in for a nasty surprise when I complete their tax return because they've sold their primary residence without actually understanding the tax impact of that event. It happened to me yet again yesterday, and I decided it was time to do a video. So if you've never shared one of my videos before, I certainly encourage you to share this one so that we can get some good information out there. It is the top 3 mistakes that I see homeowners making when they sell their primary residence. The number 1 mistake is assuming that every penny you've put into your house counts when it's time to sell your house. There's a thing called basis. Basis is all of the money that you've put into your house, including the purchase price. But it's really just for the major things, okay? So that means I'm only looking for things like a new roof, a new major system like an HVAC system or septic. Did you install a pool? Any major remodels? Did you add an addition? There are a lot of things that can increase the life of and the value of the property, and those are the only things that I'm really interested in at this particular juncture of the process. The second major mistake that people make is to assume that this is going to be a non-taxable event. Couldn't be further from the truth. There are times when it is taxable. The government does allow us to exclude up to certain thresholds of profit that we make on these properties. Now, if you are single or married filing separately, you can exclude up to $250,000 of profit on a property, your primary residence that you sell, or $500,000 if you're married filing jointly. What that means is that you can make up to $250,000 or up to $500,000, and you do not have to pay capital gains tax on that property. And honestly, I see this more often with my single filers. They will sell a house that they've owned for 10, 15, 20 years and make a $300,000, $400,000 property or profit on that property, and are confused as to why they owe any taxes on their primary residence. And the answer is because anything over $250,000 of profit is subject to capital gains tax. So if you're an individual who has sold your house for $300,000 in profit, you're going to be paying capital gains tax on $50,000 of that profit. The other mistake within this same area is that people very often forget that there are rules as to how long you have to live in the house. For most people, it's 2 out of the last 5 years, although if you are a military member, that rule is slightly different, so make sure you talk to your CPA. I very often get people who've only lived there for 12 to 18 months, and I cannot get around the capital gains tax rule because they haven't lived there long enough. So you definitely need to be talking to your CPA before you sell the house so that you understand where your tax burden is going to land. Now, the third major mistake that I see is for people who generally take a loss on a house or incur a loss on a house. It does happen more often than not where people do not make the amount of money that they spent on a house. So what happens is they've got this loss and they're expecting that to offset other taxes. That does not happen. Just as much as the government doesn't make us pay capital gains up to a certain threshold of profit we make on a house, they're also not going to give us a tax benefit for any loss we incur on the sale of our primary residence. So when I see this go wrong is when people know they're going to incur a loss on the sale of their primary residence, and then they go and liquidate something like a retirement account, assuming that loss is going to offset the taxes that would ultimately be calculated on liquidating that retirement. And then it blows up in their faces. It doesn't work that way. So again, talk to your CPA. Now, when I'm working with somebody who has sold their primary residence, there are about 4 or 5 things that I'm looking for. And number 1 is I want the HUD or ALTA statements from when you purchased your house, as well as those statements from when you sold the house. There's a lot of information in there that I'm looking to try and help you out. The second thing is any major purchases you've made for the house or major repairs. We talked about that earlier. New roofs, HVACs, pools, additions, remodels. I want a listing of all of those so that I can make sure to include that while I'm doing your taxes. The other thing is I want to know about selling expenses. So earlier I told you we couldn't really include painting and carpeting, and that's the case while you're living in the house and decorating. However, if you are no longer in the house and there are things that have to be done in order to prepare it for sale, now it becomes a selling expense, and that is something that I want to know about. The other thing I need to know is just how much time you spent living there. Now, clearly I know when you purchased it, but especially when it comes to military members, sometimes you come and you go, and I want to make sure that I include all of the time you actually lived in the house. And then for those of you who rent your house when you're not living in it, I need to know that as well, because very often depreciation is taken on the building that I have to recover when I do your taxes and can affect whether or not that becomes a taxable event for you or not. So the overall reaching message here is don't go sell your personal residence without first talking to a CPA about the potential impacts on your tax burden at the end of the year. Because the other thing is if it's going to be too much, you may get penalized for not having paid estimated taxes, and things can really snowball. So again, make sure that you give us a ring. We can help you. We can certainly help you here at Pixel. We try to do as much as we can for our clients to make sure they're prepared for the end of the year. But talk to a CPA. Thanks, everybody. We'll talk to you soon. Next week, I'm going to go ahead and I'm going to talk about investment properties because that's different, actually. It doesn't work the same as your primary residence. So we'll see you next week.